Well, hello and welcome to Capital Decanted. I am delighted to be joined here from Tokyo, from Stuart Wrigley. Stuart has two different roles at Sixth Street. He runs their Asia Pacific business, and he also runs capital formation outside of the U.S. Stuart, welcome to Capital Decanted.
John, it's me who's delighted. I'm delighted to join you today. Thanks for having me on.
Well, we're thankful to have you. Sixth Street played a important role in this kind of global listening tour around the world that we've been talking about 8 different cities across the world, and just an amazing mosaic and kind of gem of information about where we think the world is going. So I wanted to unpack a little bit of that with you, Stuart. You're in a very unique seat, or 2 seats, as I said a moment ago. So I first want to kind of press you on some of the conversations you're having on the capital formation side in that capacity as a role. And I want to focus kind of on the geopolitical layer that and the dynamics that we're seeing play out in real time in the Middle East, even as we record this, but certainly this has not been a new theme. So I'm curious first, maybe if I could focus in on this bifurcation of East versus West, China and the U.S., and this reshoring and kind of rebuilding supply chains closer to home, as you might say. How does this affect in your discussions with LPs capital formation? Does it open doors to other hubs? Is it separating the world? What have those conversations been like?
It's interesting, John. I've also been on a listening tour. So I'm in month 8 at Sixth Street, having previously spent 24 years at Goldman Sachs. And when I joined, I took it upon myself to travel around the world and try and meet all of our LPs to frankly take a mark to market of what is happening. So a lot of this topic is pretty fresh with me. So in terms of this kind of this, let's call it this bifurcation or what's happening with geopolitics. So there's a couple of aspects to this. So there's obviously the US-China relationship, which is probably the most kind of profound or pronounced instance of what is happening at the moment. And really it goes both ways. I would say, John, this is not new. This has been an issue for the last 2 to 3 years. And if you think about it from the US allocators' perspective, increasingly they are asking GPs to be able to deliver global strategies and global products, excluding China. Now, that is not necessarily a directive saying we do not want to invest in China. Sometimes it's a preference because the Chinese economy has been sluggish for a while. Private capital has been trapped for some period of time. I do think that may be slightly loosening at the moment, at least from the US side. You've seen that in the second half of last year around public markets, where people kind of somehow like their memories were shorter around some of these geopolitical issues when they saw opportunities in those markets. I don't think people are going to rush back into private markets in China soon, but I do think that is being revisited. But it also goes the other way as well. And I think it is increasingly harder for large Chinese government allocators to allocate to the US, and in some cases to US managers. We, as a US manager that invests significant amounts of dollars in the United States, we're hopeful that'll change. And I also think it will need to change because some of these pools of capital are just so large, John, that to exclude the US or exclude incremental inflows into the US is very, very tough. And then the second part of your question around new hubs forming, the most pronounced example of this is in the Middle East, where I actually spent some of the formative years of my career. I actually was based with Goldman out there for 13 years. And the Middle East has always been a great place for capital raising, but it's actually changing the Middle East at the moment as well. There are huge transformations happening in these economies, whether it's the UAE, whether it's Qatar, Saudi Arabia, Kuwait. And these destinations are no longer just about raising capital, but people have been increasingly looking to deploy capital in those countries. And it's increasingly being asked of GPs like ourselves, don't just come to raise the money, but think about what you can give back. Now, of course, people are only going to do things when it makes economic sense to do things. But we just actually, thankfully, before the troubles hit in the Middle East. So we actually held our annual partner offsite for the 42 partners of Sixth Street in Abu Dhabi at the end of January. And I must say, like all of us were like really wowed by what's happening in the UAE. So frankly, we're looking forward to hopefully these unfortunate events to be over soon, so we can get back to talking to our partners there and doing what people want to be doing, which is the fun part of doing business together. I would also say, finally, John, that kind of places in Asia. I'm based in Singapore. I'm in Tokyo at the moment. Hong Kong. Like these are also important sources of capital for GPs like ourselves.
Well, we certainly share. I think all of us share this hope that this is a quick resolution, because we share your optimism. Spending a lot of time in the Emirates, in Saudi, and other Gulf countries, and just see the opportunity for growth and coordination in developing this private capital ecosystem you alluded to. If I zoom out, because you made a couple of interesting points that we've been spending a lot of time thinking about and talking about on this roadshow as well. This idea that either because of optics, they might not want to invest in certain parts of the world, or perhaps there's fear of locking up capital given the uncertainty. These are discussions and decision trees that even 5 years ago, there wasn't nearly as many of. And we had this for most of our career. We've lived in a world that has been largely globalizing at a fairly consistent pace, and there was harmony for the most part across the world. And now suddenly LPs have to have this geopolitical overlay, and this, what we're calling in this new report, a geopolitical literacy that they've maybe not had to have before. Are you seeing this in those discussions develop beyond this tactical tool of short-term moves in their portfolio to something that's much more part of their investment thesis over the long term?
Absolutely, John. We're seeing it at the LP level, but we're also seeing it as ourselves as a leading GP. You're right. If I look back to, let's call it pre-Russia, Ukraine, pre the kind of like the US China tensions growing. Geopolitics used to be something that you used to read about at the weekend, and frankly, it was a little bit more driven by intellectual curiosity than necessarily kind of through an investment lens. Now it's absolutely part of filtering for investments. It's part of the underwriting. And we're finding that firms like ourselves and our LPs are looking to bring more kind of geopolitical resources in-house. So actually, just last week at Sixth Street, we announced the hire of a gentleman called Sir Richard Moore, who's joined the firm as a senior strategist. Sir Richard, previously, his last role was the head of MI6, which is the UK's intelligence service. So John, he wasn't James Bond; he was James Bond's boss, and he's really joined us to help us think real time around these geopolitical issues, and frankly, make us a better investor. And like there was no foresight to bring him in a week ago. But even in just this kind of week or two, we've been working with him. Having this real time insight is just hugely powerful. Then if I look on the LP side, like some of our LPs, particularly the larger ones, are finding their own resources, but they're increasingly relying on managers like ourselves to actually help them with that. And I actually think when people think about manager selection on a go-forward basis, obviously like best top quartile returns, stability of team, things like that are table stakes. But LPs are increasingly asking, like, how can you help our broader investment process beyond just returns? And geopolitics, technological shifts, the advent of AI, all areas like that are just things that they're drawing upon expertise for ourselves and our peers.
Yeah, I think that chessboard, or the risk board, whatever metaphor you like, is shifting in, I think, transformative ways that we've never seen in certainly our career. And I think we've moved past this kind of tactical shift based upon conflict or disagreements or trade wars to something that's much more foundational. So I like the way you put that. And by the way, you hire James Bond's boss, and that's about as good as it gets. So well done there. Let's talk a little bit about convergence of public and private. You've kind of alluded to this through a couple of those geopolitical answers. But in the New York roundtable, the one that Sixth Street was kind enough to participate in, um, there was a conversation around the arms race for M&A, kind of this desire to get bigger and broader as far as your inventory of offerings of strategies, both on the traditional all the way through the spectrum of the private capital opportunity. And that quote was, without scale, specialization, or professional leadership, many may be swept into a new wave of consolidation or even obsolescence. So this idea that there is a messy middle, you might say, that's developing. Either you're highly specialized boutique, filling that kind of niche portion of the portfolio that no one else can do as well as you, or you're this supermarket that has everything with great scale. What do you think about that thesis?
I think well, firstly, John, there's a lot to unpack. There's a lot to unpack in this. So firstly, I would say like there is clearly like consolidation happening amongst private market managers at the moment, and I think there are a couple of driving forces behind that. One is frankly the demands of the LPs. LPs are looking to do more with fewer managers at the moment, and that can be driven by resourcing on their side. It can be driven by the economic incentive that comes from doing different strategies with the same manager. So they're often looking for managers who can deliver a broader breadth of strategies. And then there is also, frankly, a resourcing question. As we've entered kind of a different part of the cycle where it's harder to generate returns through areas like financial engineering, and you've got to actually think about value creation. We've just spoken about geopolitical resources, like funding all of these resources is harder for the smaller GPs. But I think the challenge around this John, is what does it actually mean to have different strategies, and whether you're really getting a benefit there, because many of the private market firms started life, and I'm going to give a crude example, started life as a private equity firm. They then built a real estate business that they bolted on. They then bought a private credit business, and they've built by brick. The way we've done things at Sixth Street is different. We were a multi-strategy investing firm from day one. So we will invest in all of these asset classes per se, but typically when people allocate money to Sixth Street, they're asking us to think about the allocation between these different strategies, frankly, based on where we see the best risk-adjusted return at any point in the cycle. So to come back to your question, I do think there is a huge benefit for being larger and being multi-strategy, but that is not just piecemealing things together. That's when you can look across the different strategies and use that to your advantage. The final thing I would say on this is larger is not necessarily necessarily better, and I think this comes a little bit to that bifurcation you were talking about. As some managers get larger, often as they go public, their North Star becomes AUM growth, how that feeds into fee-related earnings, how that drives share prices. We think at Sixth Street, we found that like the right ground, we're of the right scale to be relevant, to be able to do the larger transactions, but our North Star is still purely investment returns and delivering those to our LPs.
I really like how you distinguished, these are my words, not yours, but there's the kind of flea market roll up where you've got one organization, but a lot of different booths that are effectively independently managed, right? And then there's the integrated model where you're relying on this overlay of where on the capital stack is most interesting right now, which is what you're kind of articulating Sixth Street has grown up in. And so there's kind of, as I said, there's a layer of wisdom before you get to the underlying strategy that's trying to hold the LP's hand through where is the best approach for purposes of their portfolio needs. So I think that's really helpful. And that is, it might look the same, those two firms from the outside, but actually it operates very differently.
I think that's absolutely right. Let me just bring that, if you don't mind, John, bring that to life through kind of a real life example. If I look at like the annual deployment of Sixth Street over a period of time, take something like large cap direct or US direct lending. 2022, 2023, we were doing an enormous amount of that. Spreads were 650 over, and it was like, frankly, a golden age for that type of investing. The last 12 months or even longer, when spreads have come in significantly, we've done very little. On the other side of that equation, 19, 20, 21, 22, even 23, real estate, we were doing very little. In the last couple of years, we've been putting out $2.5 billion a year because we think we're at a different point in the cycle. And I just think having that flexibility to think about units of return and units of risk across asset classes or themes, I think is super valuable. And where we are in the cycle, I think is going to be an even greater differentiator than it has been before.
Absolutely. It was interesting. We were in Toronto for that leadership roundtable the second week of April last year, and you can imagine, if you remember your calendar, that happened about a week after Liberation Day and all the tariff discussion. Although this came back up, this idea of a new regime, U.S. exceptionalism, came back up later in the year when we were in your part of the world, in Singapore and Hong Kong. So we had certainly had runway between the tariff extravaganza of the spring, but there certainly was this ongoing pattern of questions about higher structural interest rates, higher structural inflation, higher velocity of capital, more volatility, and even things like what is the risk-free rate globally if the U.S. is not considered that safe haven anymore. So I'm wondering again, I'm calling upon your wonderful dialogue, because it's just you've got this great arms of conversations that you can draw upon. How are LPs thinking about their decision making and underwriting and modeling, Stuart, in a world that is just in a very different regime than we've seen for most of our career, actually?
Yeah, John, like this is the heart of, I think, the kind of the paradigm shifts LP are going through in their minds, and therefore how they think about allocation, but also how they think about manager selection. I don't want to say it was easy before, John, but it was definitely easier when you had loose monetary policy, when credit seemed to be perennially tightening, and frankly, everything was kind of moving up and to the right. But now, frankly, GPs are going to have to earn their fees, and you have to have that shift of mindset that I spoke about earlier, from financial engineering to more of real value creation. So, what are LPs saying? LPs are saying we're going to look at manager selection through a slightly different lens. We're going to look at how people source transactions. We're going to look at how they've dealt with kind of previous credit cycles. Do they have value creation resources? And then when I think about Sixth Street through this lens, the vast majority of what we do, number one, is proprietarily sourced deals. Secondly, we have an incredible amount of resources in the firm, but to the point we made earlier about how firms are constructed, we don't think in terms of asset classes. We don't have silos. For example, we have one software team that could do a controlled buyout all the way through to a senior loan. When our real estate team buy an asset that touches healthcare, our healthcare team get involved. So I think the setup and the DNA of a GP is super important. And then I look thirdly at our leadership team. They've been investing in credit markets, and frankly, many of them were kind of the fathers or like the early pioneers in private credit. So they're some of the few who've actually lived through prior credit cycles. And then finally, we have a group within Sixth Street that we call More Than Capital, which is basically how can we add value to the companies we're investing in or lending in or providing solutions to, rather than just capital. And so what LPs are asking, they've got this new checklist where they're thinking about what are the resources, what are the sourcing, and how can we ensure that the deals they're doing are the right ones in this later and more difficult part of the cycle.
Mm. I want to press you on private credit a little bit, because again, we're recording this after what seems like another kind of episodic kind of blow up of noise and news flow around particularly these semi-liquid structures and offerings for the high net worth world of private credit loans. And often these social media posts and a lot of the noise is around, why are they gating? That's unfair. There's no access to liquidity when they're actually designed that way. But I think, to be fair, there still seems to be a disconnect on the part of the way these things are communicated or understood, or maybe being sold to the client. And there's still misunderstanding, which, by the way, gets back to education and Kaya's kind of role in this industry. But that aside for a moment, in New York, there was a healthy discussion, again, that the Sixth Street was a part of, as to whether we've gotten a little over our skis in this kind of product proliferation that's gotten a little bit ahead of kind of strong communication, education, fiduciary responsibility. Where do you think we are in that balance, given the news flow that seems to be a rerun every few months?
Well, this is a big topic, and frankly, one where I have pretty strong views, John. What I would say first and foremost is what I'm about to say on this topic is not about whether individuals should have access to private market return streams in their portfolios. They absolutely should, because they are an important source of alpha and incremental return for exactly the same reason the world's largest sovereign wealth funds and pension funds do. So premise number one is, like, I think it is right that these return streams should be available. But you hit the nail on the head. It's really a question of structure and this issue around semi-liquids. Sixth Street and the firm has spoken at length and publicly for a long period of time about the risks of assets and liability mismatches. And what you're really doing with these products or these structures is you're raising capital with the expectation of a potentially short-term liability, and then you're going and you're investing them in longer duration assets. And frankly, that is finance 101, that, like, risks emerge when you have significant asset and liability mismatches. And we're seeing this play out real time at the moment. You also hit on a really important point, that these things need to be sold appropriately. We all need to remember that higher returns come with a combination usually of higher risks and often less liquidity. And the onus is on the GPs and the industry and practitioners like yourself and your organization, John, to really ensure that the right education is happening out there. I do think, though, that whilst there's a lot of negativity around this at the moment, I actually think, when I come back to the Sixth Street lens, that this might be creating a really interesting opportunity for us. I mentioned to you previously that we haven't been very active in large cap or US direct lending for a period of time now, because the amount of money coming into this space through these retail and semi-liquid vehicles that we're forced to deploy every month to avoid a cash drag on returns have just compressed spreads so tight that they're not of interest to us. I actually think what is going to happen now is you're going to see an opportunity for spreads to widen and frankly reach a more attractive risk-adjusted return for people like ourselves. And I think some of the problems that the real estate semi-liquid vehicles had a few years ago are a good example of that, where some of these funds are just seeing in monthly quarterly inflows return for the first time. And during that period where there were no inflows, there were really interesting opportunities out there as well. So I don't think it's all bleak for private credit, but I do think this is a really good reminder of some of the fundamental kind of principles of kind of how you sell things, and frankly around asset and liability mismatches.
Stuart, I think that's really well said. Very good, balanced view of kind of both the challenges and the opportunity long term. I was reminded, actually, on this whole issue of democratization of private capital into high net worth at the beginning of my career, which I'm dating myself on a little bit. But the second year of my career, I was an analyst, and I was following Southeast Asian tech and telecom. And I think I'm 6 months in, and the Thai baht collapsed, and then the Korean won caught the cold, and later the Russian ruble, cratered, and it was ugly. And so I felt smart for about 3 months as a goofy 22-year-old. And then the world, just this contagion took over. I was reminded in some of the Asian roundtables last year that those scars, just like they do with me, those scars are still there for a lot of high net worth Asian investors. And as a result of those generational scars from 30 years ago, they still are a little bit more conservative than what you might see in the West from a high net worth perspective. And so they're perhaps more uh, cynical or slower to kind of adopt some of these new semi-liquid access wrappers towards private capital based upon versus, I should say, the U.S. counterparts or even the British counterparts. Do you see some of those regional differences play out in your conversations as you travel?
So firstly, John, I'm actually really reassured to hear that people still have scar tissue from kind of prior crises. And I think that's like going to be super important going forward. Like we are late cycle in credit at the moment, and we're seeing more and more higher frequency of examples to illustrate that. And I worry a lot about like the scarcity of people who've actually lived through credit cycles before. So I actually think that scar tissue is super healthy. It's actually quite hard to answer your question though, because at Sixth Street we don't have any of those semi-liquid strategies. So what I see is more anecdotal, but I do know that the Asia Pacific region has been an important kind of source of capital for these vehicles. And I also do understand that like capital has flown out of Asia as well. So I'm not sure you can kind of give that broad brushstroke that kind of Asia has been more immune to that. If anything, it feels to me that it's been pretty evenly spread. But that's again based on what I hear anecdotally.
Yeah. Well, I think it speaks to your last answer, which is regardless of who you're speaking to, regardless of the level of scars and PTSD like I do from my first 2 years in the business, ensuring that we're using careful, balanced fiduciary communication and language and holding their hand through this versus kind of marketing buzz, right? Which I think sometimes our industry can fall prey to. So, Stuart, it is such a pleasure to have spoken to you. Thank you for tuning in late at night from Asia. Really appreciate your comments, and I think they've added a lot of kind of tapestry to the release of this new report. So I really appreciate your time. And Capital Decanters, we will see you next time on Capital Decanting.
Thanks so much, John. It's been great joining you and great chatting.